The Korean government is set to unveil measures to put the brakes on the country's household debt. But with the central bank indicating a rise in interest rates, there could be trouble ahead for those who've taken out loans. Kim Min-ji reports.
The Moon Jae-in administration will be pulling out the stops to curb the country's mounting household debt. Set to be unveiled Tuesday, the measures are expected to put tighter controls on loans as well as tougher regulations on owning multiple homes. It's also expected to provide support for those with financial difficulties, such as the self-employed, low-income households and people with low credit scores.
We are seeking various ways to put the brakes on the double-digit growth of household debt and bring it down to the single digits.
The country's debt stood at over $1.2 trillion as the end of June, up more than 10% from a year earlier. The measures will provide a glimpse into how the administration plans to tackle the issue over the next 5 years. However, it's not all good news, with mounting speculation that the Bank of Korea may raise its key interest rate in the coming months. Last week, the central bank raised the country's economic growth forecast for this year to 3%, with the BOK governor saying the economy is ready to move away from monetary easing. Although a low interest rate was one of the key factors for growing household debt, a rise in the policy rate will quickly mean higher payments for borrowers, causing them even more difficulty. Korea's benchmark rate sits at a record low of 1.25%, and a rise would be the first in 6 years. Experts say, in view of the government's forthcoming measures, the timing of any interest rate hike needs to be carefully managed, and that both external and internal factors need to be taken into consideration. Kim Min-jae, Arirang News.